Joining with our next fundamental guest of the show, we have Aishwarya Dadich of Fident Asset Management. Aishwarya, good morning. So good to have you on the show.
Good morning, Ravita. Good morning, and good morning to all your viewers.
Hi, all right. Aishwarya, plenty of volatile situation happening on the global front. We have rising dollar yields, and now we have the Russia-Ukraine tensions, which has cropped up again. So, do you expect the markets to see any solidified recovery anytime soon?
So I believe over the last 2 months, the sentiment has taken over. The fundamentals has actually taken over sentiments. The last 3.5 years, the rally which we have seen has led to, I would say, very stretched valuations. Valuations were difficult to justify, and this is what we were talking about over the last 6 months, 8 months kind of time period. And we saw that this trend where, now the investors primarily are giving or justifying their investment theses when they are comparing the fundamentals with the valuation that they are there. I believe that has given a very strong downturn in the market. And I believe this, we have roughly seen 10% kind of a decline from the highs across the breadth of the market, both large cap, mid and small cap. I believe it's bringing a lot of sanity into the system. And very simple reason for it to have happened is the kind of EPS cut that we have witnessed. Especially the cut started in the first quarter FY25, but market was pretty lenient that time. They were not pretty, I would say, were aware, or I would say, were uh, scared of this cut. So they were just giving it a thumbs up. But after the quarter two numbers, when they saw that there is 7-6% kind of an EPS cut for FY26, I think the market mimicked that. And on top of it, we saw FI selling, which accentuate the whole problem. And obviously, we are seeing the way the geopolitical risk has also picked up in last couple of sessions. We have election around the corner, which is bringing all the volatility at one point of time. And that's why we are seeing a weak set of market right now. But coming back to your question, what do we see going ahead? Simply, Ravish, I believe see there are three things for us to take a view on the market. One, obviously, is the macroeconomic indicators of our country. Second is how the earning momentum will pick out. And third is the valuation. So if I look at the first part on the macro side, I think apart from one or two data here or there, especially there has been some spike in inflationary data point. We have been a bit concerned on consumption as a theme in the growth part, are some hiccups that we are witnessing in the system. But I believe they are more or less in a good state, so we don't have to worry much on that side. Coming to the most important point is earning momentum. I believe now FY25 earning expectation on the consensus is close to 5-4%. FY26 is in mid double digit. And I believe if the recovery happens in possibly say the quarter fourth of this FY25, even if we have a muted or decent number in quarter three, we will be able to sell it through. And last but not the least, the valuation have come back to senses. That is where, a lot of the froth which was there, especially in the SMEs and mid caps and small cap, I won't say all of has been taken care of, but large part of it has been taken care of from the system. So I believe a lot of this money which was waiting on the sidelines, especially for the institutional investors, can be jumping on the market in some coming months.
All right. Aishwarya, you said that the valuations have come into consensus. So, does this mean that Nifty can finally see some recovery in the upcoming sessions, or is it still a time away?
So obviously, if you see historically, market has changed turns whenever they have this valuation comfort or discomfort. Right now, as we see ahead, Nifty is now trading roughly around 20 times forward. If you see last 5-7 year average, that is close to that 20 times. If you see 10-15 year average, that number is multiple of close to 18 and a half times. So we went almost 23-24 times to now almost trailing 22 times, forward 20 times. So valuation is an area of comfort from where we believe market can see incremental buying. But that is not the case for mid caps. I think mid caps are still trading at 30-40% premium to large caps. Even in small cap, we have seen a lot of valuation derating has happened. But like, I can still see a lot of names where the fundamentals and sentiments are completely not in sync. So I would say rather that one has to be very careful where they're putting up their money right now. Even institutional investors, so FIs obviously are selling. I think they are on the longest selling spree in the Indian market history in the recent times. But institutional investors who are sitting on cash, they are being very choosy about the sectors they want to get in. To say private banks could be one, or BFSI could be one pack where they are seeing value. Uh, IT has moved up as we've been bull on IT over the last year or so, but there is a place where growth is more sacrosanct with valuation. So those are the pockets, possibly pharma is also one of them, where they will see that money being flown into, and that will support the market. Coming back to your question, I don't expect a very sharp recovery, at least for the month or two, because what we at Fident, we've also been very vocal about it, that FI selling will possibly continue over this whole calendar year at least. And most of the investors will be more in a wait and a watch mode about the way when Trump takes over in late January, the administration policy that it will pave through, what will the kind of momentum Fed will take on the interest rate cut, given the uncertainty now, and possibly whether we will see decent quarter three numbers. So I believe market will wanted to see more cues from there and possibly will take a direction. But last but not the least, one thing which questions the whole thesis, Avishai, here is that if I look at the flows which are coming, especially the non-institutional investors, that completely surprises us. That is not only in the large cap, if you look at mid cap, small cap, or even in the micro cap segment, the kind of money which is moving from non-institutional investors is very, very robust. If you look at our SIP numbers, obviously the gross numbers were close to 23,000, but look at the net numbers for the last 1 year monthly. It has been moving around very stable, say 7,500, 8,000 numbers. So that inflows will continue to be there. And if we see any good surprises, then I can answer your question that possibly we will see a good recovery in the market. But we are not very optimistic, at least for the next 1 month.
Okay, okay, all right. We discussed, you talked about IT and then banks as well, and of course, pharma names as well. But what about railways and defense? Because that also has seen a significant, maybe about like 10 to 20% correction in this market fall. Do you find the valuations have become attractive for those two sectors?
Definitely, this is one of the sectors we have completely avoided at Fident over the last 8, 9 months. Railways, possibly because the valuations were so stretched in the last 6 months that it was little difficult to satisfy the requirement, or I would say that any investor was coming new, had anything on the table for them. But obviously, defense is a different story. I
Yeah.
believe defense, the potential of growth is huge, and I believe the momentum of deal pipeline, order book, and the way the global world is changing, government reforms and focus on becoming a big export hub. I believe defense is an area where possibly after many of the stock have seen correction of 30, 40% from their respective 50 all-time highs, are an area where investors should look at. But one has to be very, very careful that which particular segment of defense they are trying to put their money. But I would say railways can be safely avoided even after the decline that we have seen in the last 4 months.
Okay, all right. Any other sectors that you find attractive after this recent market fall?
One sector which we believe that could really create alpha in coming times for me is chemical as a space. We believe even chemical, if I just overlap it with CDMO or CRO companies, I believe obviously if you look at the monthly data of chemical prices, we are obviously seeing pressure there. And China is just not helping on economic parameters. That is because that is dictated by China and their prices there. But there are many companies in India which have been created with good amount of capex, have created capabilities, have spent a lot of amount in R&D, especially in sectors like say electrolytes, which are used in EVs, the chemical products which are required in batteries. Some CDMO CRO companies which are possibly seeing growth in US and possibly to small extent if China one plays out. I believe there's a valuation comfort in some of these chemical names, some of the CRO companies' name, where we believe that the growth can pick up. Obviously, there is a 6 month haziness on the growth side because it's end of the day, it's a commodity which will play out. But I believe the valuations are factoring in that there. So there is one area where we are very carefully moving around. We have seen many of those companies cutting their capex, cutting their revenue guidance. So you just can't spray and pray that, okay, I've invested here and we will be able to make good money. But there are certain companies in some particular sectors which we believe even have done very good in earnings in this quarter, in the last quarter going ahead, and they have better visibility. So electrolyte is definitely one of them, a sector which we are very positive and we have gone overboard and have positioned in this particular names.
Okay. Aishwarya, we did talk about, FII's outflows is going to remain the same for the remainder of the year. How does the next year look like? Because we are expecting to see Trump resuming White House in the month of January, but we've seen rising dollar and as well as yields. So so do you expect the FIIs to make a comeback at least in the next year, or how does it look like?
In very short, they will. Will have to, right? If you see historical 20 years of time frame, there have been stages where FI have sold India left, right, and center.
Yeah.
Very recently in 22, we have seen that kind of a trade which went almost 5, 6 months. Now, things this time there is different in the sense that the intensity is very high. The count of selling that we have witnessed in the last 1.5, 2 months is relatively high. But if I look at from the overall holding perspective, I believe they are at almost more than a decade low holding in India's structural story. They are closer to at 17%. And when they compare it to other emerging markets, especially Asia, I think India is now at the bottom of their holdings there. I would say that possibly, as I said, if I, selling will possibly continue because the money is obviously moving to US, rising yields over there, the huge amount of the whole economic recovery which is visible, and especially after Trump coming back to power, is where we are seeing pressure, even with the hardening of the dollars and things like that. But we should not forget history. And if you see when the last tenure of Trump, when he was there, we have actually seen dollar weaken during that time frame. We saw the deficit of US went from 3% to almost 4.5%. Dollar weakened, and we all saw that a lot of these emerging markets currencies were stronger, and a lot of money flowed there back. And once we have moved out of this whole, slowdown story, whether it is really sacrosanct or structural, I believe FIs will make a comeback, and possibly they will come back at a much higher prices in many of those. Because as I said, the non-institutional investors in India, that financial adjustment saving, if you look at the mutual fund data, last 4 years, the kind of new additions is the large chunk of the investors' folio which has been added. And I believe
True.
that possibly will continue, because the ability of other assets to give that kind of a yield is very, very limited. So, in short, coming back to your questions, I believe if India maintains this 15, 16% growth for FY26 and the political stability around, I'm hoping there's no major geopolitical event in China or, sorry, in Europe, and if China blows out and things like that, which we can't control, I believe FIs will possibly come in mid of FY25 or March, April FY25. Closer to that, I think that is what we at Fident believe will be the turnaround story from that side on a 5 by.
Okay. Just one last question, Aishwarya, before we let you go. What should investors' trading strategy should be at this point of time? Should they sell on every rise, buy on every dip, or what should it be? Because you're saying that the recovery is yet to take a long time. FII is also expected to make a comeback in maybe March or April, May. What should their trading strategy be at this point?
It completely depends on the investment strategy. I would say that investors should stay put, provided they are into good companies. And a lot of those good companies, what I mean, we meant by good companies, business who have been consistently reporting growth, businesses who have a strong balance sheet, good brand, and possibly a good capital allocation track record in the form of ROEs. If these companies, I can see a lot of these companies, especially in mid and small cap space, where they are at least 20 to 25% cheaper. I think that's where the money should be deployed. One thing which is completely differentiating between whether you will create wealth or whether you will not create wealth is whether your companies where you're invested are growing. If you're not seeing cash flow growth and profit growth, possibly that whole narrative about, the full theory which works will possibly create a wealth restriction for majority of the investors. So even if you see the last 6 months has been a very tough market in the last 4 years of bull run, and we sincerely believe that making money from here onward for the next 1.5, 2 years would not be very, very easy. Like, because this new set of investors who have onboarded, they're used to it making quick money. Market goes through phases, and we possibly are entering into those phases where quality will take over hit on businesses who just are based on narrative or stories without substance. So I will urge all the investors to just focus on their portfolios, go back to the boardroom and check through whether these companies are growing, they are decent set of companies. Even if the stock prices are down 10-15%, nothing to worry about, right? And if you have the dry powder with you, go and stagger your investment in a couple of months into these companies like this. If you are lucky that if you are many of those companies which are not strong and they're still standing, I would request people to take money off even at 10% lower or 15% lower, because things might completely turn out differently for ill-fated stocks or ill-fated business.
Okay, all right. Aishwarya, with that, we have to let you go, but thank you so much for your time and for your valuable insights as well. We hope that we connect with you soon.
Thank you. Thank you so much for having me.
Okay. All right, let's take a quick check of the markets right now.